Just in, the fiscal report is out and the government deficit is surging. Is the US headed for a debt crisis? Yesterday, the monthly Treasury Statement was released by the government, and there's some shocking news related to our government's finances, both good and bad. Let's take a look. So, here is monthly spending, and we can see for the month of July this year, the government spent $629 billion. Now, if you annualize this out, it works out to $7.5 trillion. Of government spending. And if you take that 7.5 trillion as a share of GDP, this would work out to about 25% of GDP. Now, it's important to mention Bergen Henderson, two Scandinavian economists, have found that as a country's government spending becomes a larger share of GDP, this red number going up, you get less and less GDP. Well, GDP is your denominator. That's your real productive growth in this equation here. So if the denominator is falling and you require more and more federal spending to get the same amount or actually decreasing amount of GDP, this goes non-linear eventually, as we're seeing kind of in the UK. We did a video on that I'll link at the end. Here is the monthly surplus or deficit. Remember, when we talk about the deficit, it is just the difference between government spending and government revenue. So we can see that the difference between spending and revenue was $291 billion for the month of July. This is higher, much higher than the kind of historical trend, but also much higher than even kind of the post 2020 average, which is about $50 billion monthly, higher than that 5-year average going back to 2020. If you annualized out this month's deficit, it should be noted that there can be noise, there can be variation in the month-to-month revenue, month-to-month spending, right? During tax season, revenue side will surge, so you can't always annualize it out. But just for a rough idea of what this works out to, this is a $3.5 trillion annual deficit. Now that annual deficit as a share of GDP would be an utterly insane 12%. That is basically emerging market at that point. Luckily, we're not going to hit it. We're closer to 7.5% to end the year. Here's the unemployment rate. So that deficit, it's important to note that this deficit of 3.5 trillion, if you annualize it out, it's actually not that bad, as we'll see when we look at the MTS statement, the tables and the charts. But the deficit that we are running are a 6, 7, even 7.5% of GDP deficit. There's an important piece of context, which is this is what's called a pro-cyclical deficit. What that means is that we are running these insanely large deficits despite a relatively okay headline economy. As we can see from the unemployment rate before leading into the 2008 GFC, it was actually higher than it is now. So we have a lower unemployment rate, but yet our deficit as a share of GDP is higher by 6x. So what is driving that? Well, here we can see, here's the percent change in each outlay and then revenue in green and purple. Here's the percent change going back to the end of the gold standard, 1971. We can see interest has grown at 4,426%. Social Security payments have grown at 6,261%. The problem is tax revenue and GDP have only grown at about 3,000%. Now, this would seem really bad, but it does get worse. So here's Medicare, which has grown 20,000%. This is 6 times faster than GDP. Now, a lot of people might be thinking about defense spending. I've looked at this, and defense spending has actually grown slower than tax revenue and GDP. Then the next question becomes, okay, well, what about the off-balance sheet, black budget government spending for defense purposes? And once you include that, it's roughly in line with tax revenue and GDP. So the real issue driving the deficit and driving our debt are these three things: Social Security, interest, and Medicare. So here's one way to kind of look at Social Security and Medicare, the rate of change of each of them relative to the rate of change of tax revenue. And what we can see is back in the 60s, Social Security, if you totaled up all the Social Security payments, it represented about 15% of tax revenue. Well, now that has doubled. So now Social Security makes up a third of tax revenue. Of course, we run a deficit. So, but of the revenue that the government is collecting, Social Security just on its own makes up 32% of that revenue, and Medicare makes up 24%. So again, this is part of what is forcing the government to run these deficits because these are only two items of spending. There, we're not even talking about defense. We're not talking about the parks and DEA and all these other different agencies and needs of spending for the government. Just these two programs alone, out of revenue, represent about half of total government revenue. This is what is forcing the government to run such large deficits. As we can see, Medicare as a share of tax revenue went from about 1% of tax revenue back in the mid 60s to now 24% of tax revenue. So remember, with these relative charts, what we're looking at is the relative rate of change between two things. If the numerator is growing faster than the denominator, these lines will go up and to the right, which is sure enough exactly what we've seen. Now, here's that interest piece. Here's interest as a share of GDP and interest as a share of tax revenue. Now, the input that TradingView uses is lagged. As we will see, annual interest is not 860 billion, which is what this reflects, but actually closer to 1.1, 1.2 trillion. So it's actually even worse. We have probably set a new all-time high. Tax revenue, interest as a share of tax revenue is 20%, and interest as a share of GDP is about 3.5, almost 4%. So arguably, we've already hit a new all-time high. You might be thinking, well, in the late 80s, early 90s, we hit those numbers. The difference is debt to GDP was a third or a fourth even of what it is today. So the leverage in the system makes the situation now much, much, much worse than it was back here in the late 80s and early 90s. And so here's the monthly Treasury statement, and we'll go through this and the kind of key findings that I think are most important. So we can see total revenue 330 billion, total spending 630 billion. The difference between those two is a deficit of 291 billion. Now, customs duties for the month of July surged. We collected $28 billion in customs duty via tariffs. And we'll take a look at how that stacks up to this time last year in a second here. Here is on a cumulative basis up through July of this year for the fiscal year 25, which started in October. Here we can see kind of the cumulative amount of tax revenue from various different sources, and then cumulative amount of spending from on various different items over here. This is again up through July of this year, cumulative. We can see the government's collected 4.3 trillion in revenue. They've spent 5.98 trillion dollars. This is a major issue. So customs duties so far now, tariffs have only been in effect for a couple months now, but customs duties on a cumulative basis are about $136 billion. Now, annualizing out, if tariff rates stayed the same, this works out to about $300 billion per year the government will collect in tariff revenue. This is enough. By the way, they promised you they would eliminate the income tax. And I will point out yet again that for the bottom 75% of income earners, they pay about 300 billion in income tax. So if you collect 300 billion per year, you could take to zero the income tax for the bottom 75-ish% of income earners. Well, so far this year, we've run a $1.6 trillion deficit. It's again, this is only through July of this year. We still have a couple months to go. Here we can see how we stack up to this time last year. Receipts or government revenue has increased. The problem is that spending increased at a faster rate. So July of last year, we were running a $243 billion deficit. This year, that equates to $291 billion. And the reason for that, the reason it's so much higher this year is because spending is dramatically higher than it was even of July 2024. Here is the estimate for the full fiscal year, right? We have a couple months to go. So here's what they are estimating. Revenue, about 5.5 trillion. They're estimating spending about 7.5 trillion. So going back to the chart that we showed here, maybe annualizing out July is a safe bet because that lines up with what we found. So they're estimating spending 7.5 trillion, and then the total deficit for the full fiscal year of 25, they're estimating about $1.88 trillion. Compared to this time last year, this was only $1.5 trillion deficit as of this time last year. So the deficit is growing significantly, and we'll see the percentage increase in the second report that we'll look at in a second. It's pretty shocking. And so total financing, how do you finance this $1.88 trillion deficit, meaning the government's spending $1.8 trillion more than it collects in revenue? How do you finance that? Well, you issue new debt. And we can see that borrowing from the public, aka net debt issuance, they're going to issue $1.9 trillion for the full fiscal year of 2025. So then the debt will increase by 1.9 trillion. And again, this is mainly driven by Social Security, Medicare, and interest especially, which is growing rapidly. It's the fastest growing budget item for the US government. And again, compared to this same period of time, right, up and through July of last year, how did things look? Revenue is up, but the problem is spending is up even more. Now, the budget estimate for next year is that revenue will increase to 6 trillion and government spending will be about equivalent to where we are today at about 7.5 trillion. So this works out to the deficit improving next year to just $1.6 trillion. We will see if that actually comes to pass. So here is why the deficit is so much worse this year relative to July of last year. We can see revenue is basically in line with July of last year here in green. The problem is blue, which represents outlays or government spending, has increased faster. The amount of government spending for this month of this year is higher than government spending for July of 2024. We can see that is why the resulting deficit here in orange is so much larger than July of last year. Here's that cumulative benchmark. So this takes for the fiscal year, again, on a cumulative basis, what was revenue looking like in 2024? And what we can see is revenue is up slightly compared to July of 2024 at this point of time last year. Revenue is up, but the problem is spending is up even more. So the deficit is larger on a cumulative basis for fiscal year 25 than it was for fiscal year 24. Here's the disaggregated components where that revenue is coming from. We can see the vast majority of it is coming from individual income tax. This is just another way of displaying that same data. Here is the source of government spending. I'll point out Social Security, Medicare, and health make up the majority of outlays for the government, but net interest here in this light blue, $841 billion year to date in interest, just in interest expense. Again, just another way to display that same data. And here is a summary of that revenue and those spending items. What I want to point out, and I pointed this out last monthly Treasury statement, is that individuals are paying a larger amount of individual income tax. But if you look at corporate income tax, this is actually going down. So corporations were paying more than they are now in terms of corporate income tax. Individuals, however, compared to this period last year, individuals are paying more in individual income tax. So this is a burden shift that not enough people are talking about. Here's the customs duty. Again, this is that tariff revenue. We took in $28 billion rounding up for this month. Again, that works out to about $300 billion per year if the rates hold where they are. And currently, fiscal on a cumulative basis, fiscal year to date, we've collected $135 billion in tariff revenue. It's important to note who's paying that. So there was an article the other day in Bloomberg that found that about 65% of the tariff is being paid either by the importer, so the US corporation, or by the supplier. We saw very, very, very little goods inflation. We haven't really seen any to speak of over the past 4, 5, 6 months. So the pass through or the amount of that tariff that's getting passed to the end consumer so far is very, very low. The vast majority of it is being eaten by the U.S. corporation via reduction in their profit margin, or by the supplier, which is in another country. The actual producer of the good. So we will need to watch to see if that holds. My guess is if corporations try to pass through much more of the tariff, that you'll just see demand destruction, where consumers are tapped out and they say we can't do it. Now they're estimating $63 billion in. I think this is interesting, for the full fiscal year 2025. They're estimating $63 billion in customs duties. Well, we're already past that at 135 billion. So here's the other really major item here. Here's interest on treasury debt. We can see for the month of July alone, just interest was almost $100 billion. It was $92 billion in interest just for the month of July. Now, on a cumulative basis, again, the fiscal year is not done. It ends in October, but on a cumulative basis, so far this year, this fiscal year, we've paid $1 trillion in interest. And again, the estimate for the full fiscal year is $1.2 trillion. And of course, here's customs duties. And this is reflecting this month relative to current fiscal year to date. So up through this month on a cumulative basis. And then prior fiscal year to date, we can see that tariff revenue is surging compared to what it was last year at this same time period. So finally, we're going to end with this report here, which shows the percent change of each individual component, both on the revenue side and the spending side. So we can see what is driving, what spending items are increasing and what revenue items are the rate of change compared to this time last year. Now, this adjusted difference, what that refers to, that is factoring in seasonal variation, calendar adjustments. So February has 29 days because it's a leap year, those sorts of things. So if you're wondering what adjusted difference is, that is what it's referring to. We can see that customs duties are up 273% compared to the last July of 2024. So July 2025 tariff revenue versus July 2024 tariff revenue. The difference there is tariff revenues are up by 273%. So when people tell you or you hear on the news, well, tariffs haven't really kicked in. Well, we must be talking about Schrodinger's tariffs, where simultaneously revenue from them is surging, but yet they're not actually in place yet. So when you hear that argument, it's not backed up by the data that we're looking at right here. Total budget receipts. So this is total revenue for the government. This has only grown at 2% compared to this time again last year. So July 2024 versus July 2025, revenue is only increased by 2%. If we look at total spending, that has increased by 10%. So the net budget effect compared to July of 2024 to this July of 2025, the net effect of that is that the deficit has grown at 19%. Now, once you make the adjustment, it's only 10%. But the fact that the deficit is growing at an annualized rate of 10% should be shocking. Now, here is that fiscal year to date. So this is that cumulative rate of change for up and through July of fiscal year 24 versus up and through July for fiscal year 25. We can see that total revenue on an adjusted basis has grown at 7% compared to fiscal year 24 through July, or 6% on an unadjusted basis. And spending has grown roughly in line with that at 7% for fiscal year 24 relative to fiscal year 25. And on an adjusted basis, they're showing that total government spending has only grown at 5%. So this would be a deficit reduction if it holds. But again, using July 24 to July 25, the deficit is growing at a 10% annualized rate. So we're going to have to watch the next couple reports to see kind of which direction it ends up going. And of course, interest. So here's interest, which has grown compared to this point, July 2024. July 25, interest grew by 4%. This is right in line with the interest rate on the debt. Now, if you look through the fiscal year 24 up through July versus fiscal year 25 up through July, interest has grown at 6%. This is even a larger amount than the interest rate on the debt. There's nowhere on the yield curve that is 6%, at least not yet. So here's why that matters. And here's to answer that question of, is the US headed for a debt crisis? Here is the answer to that question. Here you have nominal growth rate. So this is the rate that the US economy is growing, factoring in inflation. Because remember, if you're the government or debt issuer, inflation actually helps you. So you have to factor that in. What you get is nominal growth. And this is a rate of change on a year over year basis. Right now, nominal growth is running at 4.7%, which is relatively in line with kind of the modern history in terms of our growth rate. It's much lower than it used to be in, say, the 50s, 60s, or 70s, but it is in line with kind of modern, the past 2 or 3 decades. Now, what really matters, though, is not just that nominal growth rate. What matters is that growth rate relative to the interest rate on the debt. If you can keep nominal growth above the interest rate on the debt, everything's okay. And generally, you see that reverse, or you see nominal growth rate fall below the cost of the debt during recessions. And this is when debt to GDP increases, is generally during a recession. You get that cross during a recession. Well, the difference is we're starting to see that now. So right now, the 30-year treasury, as measured by the blue line, is running at about 4.9% annual interest rate. Nominal growth is lower than that at 4.7. The 10-year maturity is yielding about 4.4%, so right up there with the nominal growth rate. And then the shorter maturities, like the 2-year and the 5-year, are running at about 4%. So far, if the government can keep bond yields from moving much higher and they are able to engineer a reacceleration in nominal growth, everything should be okay. Now, that's not to say that, the government won't be spending $1 trillion a year, 20% of tax revenue on interest. It's not to discount any of the other items that we looked at, but in terms of kind of stabilizing things and preventing it from worsening further, they might be able to do that if they're able to get this white line or nominal growth to pick up again and keep bond yields from moving higher. Because remember, the whole point of a bond yield, especially at the long end, is to approximate nominal growth. So, generally speaking, the way you do that, if we start getting higher nominal growth, you would expect the 10-year certainly and the 20 and 30-year to move higher in terms of rate or move down in terms of value. Well, the problem is that that the government can't afford to issue debt at a higher interest rate than their nominal growth rate. And so what we've seen is, and this started during the last administration, a shift away from issuing, 10, 20, 30-year debt and more towards issuing short-term debt. Well, that short-term debt, the interest rate on that short-term debt basically just follows the federal funds rate. So this is the whole negative real rate thing that I think they're trying to engineer, issue even more of our debt in short-term bills and drop the federal funds rate by an absurd amount. Now, this would get negative real rates. This would get the cost of the debt to drop way below the white line if we're issuing all of our debt in 1 month, 3 month, 6 month paper. But there's a consequence. That consequence is it's very pro liquidity and it's very inflationary. And the reason is that bills, short duration treasury debt, are much more cash like. They are much more money like. And so this is not without consequence. I would also expect that strategy to be very negative for the dollar. And this is kind of really the chart that I always show. Here's government debt percent change since the end of the gold standard. It's grown at 10,000% since 1971. Interest has grown at 6,800%, and GDP has only grown at 3,000%. So interest has grown about twice as fast as GDP or the overall economy, and the debt has grown 3 times faster than GDP. This is really the chart that really I think summarizes the whole issue that the government finds themselves in. So, anyways, hopefully that was helpful, educational. I will link to the 2 reports that we showed here. I will link to these in the description and catch you in the next one.